When we talk with our clients about retirement planning, inevitably the conversation turns to income tax. Clients want to know how much tax they're going to pay in retirement. They want to know how to minimize tax. And for couples, they want to know about income splitting and how to split income in retirement. Now, the focus on tax is quite understandable. It is arguably the largest single expense in retirement. It's often larger than travel, it's larger than food, it's larger than medical expenses. So the focus on tax is quite understandable. But what many people don't realize is there are a number of tax credits that are available in retirement that can help reduce the income tax you pay by a significant amount. And it's understandable why people might not know about all these tax credits, because some of them are only available when you're earning certain types of retirement income or after you've reached a certain age. Now, in this video, we're going to look at 3 important tax credits available in retirement. And these 3 tax credits, when combined, for an individual are worth over $25,000 per year. For a couple, that's over $50,000 a year in tax-free income in retirement. So in this video, we're going to look at those 3 tax credits, and we're also going to work backwards to create a retirement plan that has $75,000 a year in income with 0 tax. So $75,000 a year in income for a couple with 0 tax. Let's take a look. Now, the first tax credit that we're going to talk about is the basic personal amount. The basic personal amount is available to everyone. It doesn't matter what your age or if you're in retirement, but it's a very important tax credit for retirement, and it's worth $15,000 a year as of 2023, and it goes up with inflation every year. Now, this tax credit just happens to be about the size of maximum CPP benefits. So if you're getting the maximum CPP benefit, or if perhaps you've delayed CPP past age 65, you might be getting around $15,000 a year in CPP income, and this can be fully offset using the basic personal amount. Now, the second tax credit is available only in retirement and only after the age of 65. And this is the age amount. So the age amount tax credit is worth $8,396 as of 2023 at a federal level, and it just happens to be about the size of maximum old age security benefits. So at the moment, maximum old age security benefits are $8,251 per year, and so there's still another $145 there remaining, but that tax credit, the age amount, which is available after the age of 65, just happens to offset all of your OAS, old age security income, if you're getting the maximum. Now, the third and the last important tax credit in retirement is the pension income amount. So the pension income amount is worth $2,000 a year per person at the federal level, and it allows us to incur retirement income from a pension. So it could be a defined benefit pension before the age of 65, or as of 65, it can be also RIF and LIF withdrawals as well. So RIF, Registered Retirement Income Fund, LIF, Life Income Fund. Withdrawals from these types of accounts after the age of 65 qualify for the pension income amount, which lets you withdraw $2,000 a year from your RIF or LIF, and you get to qualify for that $2,000 tax credit. So withdrawing $2,000 a year, no tax on that income. So we've got $15,000 basic personal amount. We've got a little over $8,000 for the age amount, and now we've got $2,000 for the pension income amount. That's a total of $25,000 per person, $50,000 for a couple. Now let's take a look at an example. Let's take a look at a situation where we want to create $75,000 a year in after-tax income without incurring any tax whatsoever. Let's see how we can make that happen using these 3 tax credits. Okay, so let's try and create $75,000 a year in after-tax retirement income without any tax whatsoever. Now, the first tax credit we're going to look at is the pension income amount. To get that tax credit, we need to create $2,000 in RIF or LIF income after the age of 65, or we need to have $2,000 per person in defined benefit pension income before age 65. Now, to do that for RIF and LIF, we need about $50,000 each based on a 4% withdrawal rate. So to create that $2,000 a year, we need $50,000 in each account. So that's the first thing. Now, the second one is the age amount tax credit. So this is worth a little over $8,300, almost $8,400. has to be about the same size of old age security. So we're going to assume maximum OAS benefits, and then there's still about $145 in tax credit remaining. So we don't need any account balance because this income is going to be coming straight from old age security. Now the next one is the basic personal amount. So it's worth $15,000 per person at the moment in 2023. To create that income, maybe we're going to use CPP, Canada Pension Plan. Maybe we're going to delay it past age 65 to make sure we get that full amount of $15,000. We still have that leftover tax credit from the age amount, $145. So in total, we want to create either from CPP or a combination of CPP, RSP withdrawals, or RIF and LIF withdrawals. We want to create $15,000 and $145 per person in retirement. Now in total, that's going to give us a little over $50,000, almost $51,000 of tax credits. It's going to give us almost $51,000 in income, total of $100,000 in account balance. Now this isn't quite what we wanted. We wanted $75,000 a year. So what we need to do is we need to look at non-taxable income, and the best way to do that is a TFSA. So we need each about $12,000 per person in non-taxable income coming from a TFSA. To do that with, again, about a 4% withdrawal rate, we need about $300,000 in that TFSA. $250,000, $300,000, $350,000, depends on your asset allocation, depends on your investment fees. But let's say $300,000 each in a TFSA. That'll give us a total of almost $51,000 in tax credits. It's going to give us a total of $75,000 a year in after-tax income with no tax whatsoever. And we're going to do that with the total account balance of $700,000, a little over $700,000. So this plan, this retirement plan, gets us $75,000 a year after tax. We pay no tax on that whatsoever. And we've got a total account balance of $700,000. Now, having each $300,000 in a TFSA, maybe not the most realistic. So this could be split between maybe $150,000 in a TFSA and $150,000 in a non-registered account. Now, this is just an example. This is probably not the optimal way to create this retirement plan. Again, we don't want to just focus on tax planning and maybe ignore government benefits like guaranteed income supplement. This plan, as we built it, is probably not the best way to go about creating that $75,000 a year in after-tax income. There are probably other better ways to do it, but it's a great example of how these tax credits can work together to create a large amount of income in retirement with very little tax. Thank you for watching. If you want some help putting together a retirement plan, please don't hesitate to reach out. I'll put a link in the description for the video. If you enjoy this video, please like and subscribe. We're coming out with a new video every week. Thanks for watching.